Friends, 2024 was a watershed moment. The SEC finally approved spot Bitcoin ETFs. This was a seismic shift, acknowledging Bitcoin's legitimacy. The decision sent shockwaves through the financial world. Bitcoin was now embraced by institutions once skeptical. This wasn't just about Bitcoin, it was about the future of finance. Okay, so what the heck is a spot Bitcoin ETF, you ask? Imagine a regular ETF, but instead of tracking the price of, say, the S&P 500, it tracks the price of Bitcoin. Simple, right? But here's the kicker. A spot ETF means it actually holds the underlying asset, in this case, actual Bitcoin. Think of it like a digital gold bar ETF. You're not buying Bitcoin directly, but you're buying shares in a fund that holds actual Bitcoin. This is a big deal because it gives investors exposure to Bitcoin without the hassle of setting up a crypto wallet or worrying about losing their digital keys, which, let's be honest, is a very real concern. Before this, if you wanted to invest in Bitcoin through traditional brokerage accounts, your options were limited. You had futures-based ETFs, which track the price of Bitcoin, not the actual price. It's like betting on the price of coffee a year from now instead of just buying a cup today. Spot Bitcoin ETFs, on the other hand, are like walking into your local Starbucks and ordering a latte. You get the real deal instantly. They provide a regulated, familiar and accessible way for both institutional and retail investors to dip their toes into the crypto waters. Now let's talk about the SEC. They're like the strict but well-meaning hall monitor of the financial world, making sure everyone's playing by the rules. And the world of crypto, let's just say, has a bit of a reputation for being the Wild West. Before approving spot Bitcoin ETFs, the SEC wanted to make sure that investors wouldn't be left holding the bag if the crypto market went belly up. They demanded stricter regulations, more transparency, and robust safeguards against market manipulation. This involved scrutinizing everything from how these ETFs would be structured and managed to how they would store the underlying Bitcoin. They wanted to ensure that these ETFs met the same rigorous standards as any other exchange-traded product. This wasn't about stifling innovation, it was about protecting investors from scams, fraud, and their own worst impulses. It was about bringing some much-needed order to a market that had long been associated with volatility and uncertainty. A boon for investors, accessibility, security, and mainstream appeal. So, why should investors care about spot Bitcoin ETFs? Well, for starters, they make investing in Bitcoin as easy as buying shares of Apple or Google. No more messing around with crypto exchanges or worrying about the security of your digital assets. They also provide a level of security and regulatory oversight that's simply not available when you buy Bitcoin directly. The SEC's involvement means that these ETFs are subject to the same rules and regulations as any other publicly traded security. But perhaps, most importantly, spot Bitcoin ETFs bring crypto investing into the mainstream. They make it accessible to institutional investors, pension funds, and everyday folks who might have been hesitant to dip their toes into the crypto waters before. This increased accessibility is a game changer. It injects much-needed liquidity into the Bitcoin market, potentially leading to greater stability and less volatility. It also paves the way for greater institutional adoption, which could further legitimize Bitcoin as an asset class. Beyond the horizon, charting the future of crypto investing. So, what's next for the crypto world? Well, if the past is any indication, buckle up because things are about to get interesting. The approval of spot Bitcoin ETFs has opened the floodgates for a wave of new and innovative financial products. We're likely to see ETFs tracking other cryptocurrencies like Ethereum, Solana, and even Dogecoin, because, memes. We might even see ETFs that track specific sectors within the crypto ecosystem, like DeFi or NFTs, but it's not just about ETFs. The regulatory clarity provided by the SEC's decision could pave the way for other traditional financial institutions to enter the crypto space. We're talking about banks offering crypto custody services, asset managers creating crypto-focused funds, and maybe even insurance companies offering coverage for crypto assets. The possibilities are endless, and it's an exciting time to be paying attention to this rapidly evolving space. However, as with any emerging technology, it's important to proceed with caution and a healthy dose of skepticism. Navigating the minefield risks and regulatory challenges. Now, before you go remortgaging your house to buy Bitcoin, let's talk about the elephant in the room: risks. Crypto is still a highly volatile asset class, and even with the SEC's oversight, there are still risks associated with investing in spot Bitcoin ETFs. The price of Bitcoin can fluctuate wildly, and there's always the possibility of a major market correction. We've seen it happen before, and there's no guarantee it won't happen again. There's also the risk of regulatory uncertainty. The crypto landscape is constantly evolving, and new regulations could be introduced that could impact the value of these ETFs. And let's not forget about the security risks. While spot Bitcoin ETFs offer a more secure way to invest in Bitcoin than buying it directly, there's still the risk of hacking or theft. These are all important factors to consider before investing any amount of money in crypto. A new dawn for crypto embracing innovation, demanding prudence. The approval of spot Bitcoin ETFs is a momentous occasion for the crypto market. It marks a turning point in the acceptance and legitimization of cryptocurrencies as a viable investment asset. It opens up a world of opportunities for investors of all stripes to participate in this exciting and rapidly growing market. But it's not a free pass to throw caution to the wind. The crypto market is still young and volatile, and there are risks associated with any investment, especially one as novel and complex as this. So, by all means, embrace the innovation, explore the possibilities, but do so with your eyes wide open. Do your research, understand the risks, and never invest more than you can afford to lose. Remember, friends, in the wild west of finance, it's always better to be safe than sorry.